Hello, everyone. Good evening. Can't believe another year is in the books. Well, for starters, thank you so much for joining us tonight. As everyone on the call knows, my name is Michael Petracca, owner and operator of HAP Financial Group. Tonight, great presentation. We're going to do a kind of a macro snapshot of what 2024 looked like, and then what does that more or less mean going forward. Before I get started, if you have any questions, I will spend some time in the end to answer any questions you may have. Or if you want to just ask them as I'm going along in the presentation, feel free to just type in the chat box any question that comes to mind. In saying there's a couple takeaways that I would want to just macro off the top, and then we'll go into the weeds a little bit. For starters, probably the biggest thing that I would take away as we sit here today is that if I'm a betting man, the last 5 years and the next 5 years, in terms of market returns across the globe and in the bond market, are going to look vastly different. I do not believe overall rates of returns are going to look very different, but I do believe where within the portfolio we get those returns, it's going to come from different parts. And I think you'll understand as I go through the presentation. The other big takeaway, it's a little bit more of the personal finance takeaway. For the most part, everyone on this call tonight, I would argue, has what I would consider as a winning hand. A reality that as you're approaching retirement based on the pool of money you have and the lifestyle or budget we want in retirement, we're in good shape. So if we're sitting here and markets have given us pretty good returns, regardless if we think things are going to go to the moon, you always want to say, it's like, all right, do I have a winning hand? If we have a winning hand and I'm good and I don't need an extra crazy rate of return to accomplish my lifestyle, that should absolutely kind of factor into kind of your budget planning. To use an extreme example, let's say one of us won the lottery, won $10 million. Well, we could at that point we don't have to take any risk at all, and we can leave the money in a treasury bond or a CD, pay 5%. We got $500,000 a year, not touch our principal. So we all know, like, if we want huge chunks of change, we'd go really low risk. We don't have to worry about the stock market, the economy, anything, and have a nice, easy reality. So that's kind of the extreme concept. But to take it into your world, you know, as your situation improves, as your net worths improve, and we're now getting to very comfortable levels, that should factor into how much risk we're taking in the portfolio. Because as you'll see as we go through this presentation, we are at a point where some markets around the world are sitting at pretty lofty levels. So again, if you have any questions as I go through the presentation, feel free to put in the chat box. If not, happy to stay as long as you like at the end of the presentation and answer any questions you have. Awesome. Let's get started. Just share my screen. Okay. All right. So as always, I like to start with the US stock market. So what we're looking at here is the S&P 500 over the last 25 years. So more or less at the last 2 years have been just a fantastic, what we would call a bull rally, or a period of time where the stock market is going up. And we're sitting here within a few points of all-time highs. Well, just because the market is sitting at all-time high doesn't really mean it's cheap or expensive. One of the ways to determine that is the multiple we're paying to own stocks. Now, this is something I go over in every single one of my presentations, so it should be somewhat familiar to everyone here. We're trading at 21 and a half times earnings. So we have 100 plus years of history that we can look at and say, well, is that a cheap multiple we're paying to own the stock market, or is that an expensive reality? And I always like to give the example of a rental property. So let's say my office rents for $10,000 a year, and you want to buy it from me. Well, everyone knows my complex has about 200 other units. So you do your homework and you check what the other ones are selling for. And you see the average on this Garden Variety Wednesday is 15 times my rent. So $10,000 times 15 is 150 grand. But let's say we pick up the newspaper tomorrow and it says train station coming to Fairfield that goes right to New York City. Well, we all know the buzz around town is going to be, there's a lot of confidence, probably a lot of business is going to come here for that fact. So that multiple that was at 15, I'm going to ask now 20 because I know this land's worth more money. At the same time, Fairfield can flood. Maybe a flood happened. Now no one wants to come here. So I'll be lucky if I can get 10 times my rent. So what we know is there's the earnings. Think of that as the economy, and then the multiple. That's kind of how much confidence is in the economy. So typically, what do we want if we're having a fresh new dollar to invest? Well, we want the wind at our sails a little bit. So we want a multiple. For example, if you were buying this office from me, you would want to buy it when? Right after the flood, because you're going to be able to get it at a very cheap multiple. And I always give the example like a flood was like the 2008 financial crisis, where we were back here in 2008, 2009, where that multiple was around 10. So if we get to buy stocks at around 10, history would tell the next period of time is going to look pretty good. Hence, we went up 400% over the next preceding bull rally. The highest it was ever recorded was the multiple around the tech bubble of 2000, which was around 25. So the higher the multiple, 25, was followed up by a 10-year kind of flatness in the stock market. So what we can tell is over time, what do we want? We want to invest down here when the multiple is very cheap. We're at a point where, and this slide only goes back to 1994. If this slide could go back 120 years. It's like the Great Depression, the tech bubble, 2000, and right now, and I believe one other time in the late 50s, were periods of time where the markets were paying these type of multiples. So it is absolutely expensive. Now, what I don't want people to think is, oh, it's expensive, it's going to crash tomorrow. So the next slide kind of talks about that a little bit. So what we're looking at is, trying to predict rates of returns over the next year. The slide on the left kind of tells you it's almost impossible. So if we went back a year ago today, stocks were still expensive and the markets had a phenomenal year last year. So that was a situation where, yes, it was expensive, but we had one of these outlier years to the upside. So every 1 year period of time, rather impossible to predict where returns are going to be. But over time, so this on the right side of this slide, here's your 5-year rates of returns based on a certain multiple. So here we are between, let's say, 21 and 22, the red diamond right here. What you can see, returns are somewhat muted. So the lower the multiple, 8, 9, 10, 11, 12, you're collecting kind of that 15 to 20% rate of return, but the higher the multiple, the slope is down and to the right. I would say most big firms out there, the Vanguards, the Fidelities, and economists are kind of predicting that low to mid single digits for US stocks over the next 5 to 10 years. Like I mentioned at the beginning of this webinar, was that I believe rates of returns are going to be about the same, but where we get them from is going to be a little bit different. So in all of our portfolios, we all own diversified portfolios. That's a fancy way of saying we have a mix of US stocks, international and emerging, and the bond market. So over the last 5, 10 years, US great, bonds were crap, and international emerging was fairly blah. Now, international emerging are trading at about 12 to 13 times. And again, we're trading at 21 to 22. So they're very cheap. So they're kind of on the left side of this range, kind of in between 11 and 14. Most economists are predicting kind of that 8 to 12% range for international and emerging markets over the next 5 to 10 years. Because again, they're trading at much cheaper valuations. Is their economies growing as well as ours? No. But they're trading at a 40 or so percent discount on a multiple basis. So US stocks have had a fantastic run. It's been absolutely wonderful. It's just kind of hard to keep pushing that envelope higher and higher. So one of the things to kind of realize is, like I mentioned before, there's the multiple, and then there's the rent and the earnings. So if we say we're putting the stock market aside, because the stock market and the economy don't always have to match up. And the perfect example of that, I'm going to go back a few slides, was 2022, where the stock market lost 25%, but the economy still did okay. Because you got to realize the stock market is trying to predict where the economy is going. So that was a period of time where we were raising interest rates, inflation was crazy, people's moods were pretty much in the dumps, so stocks went down. but no one told the economy. The economy kept marching right along, hence the very sharp rebound that we did experience. But again, that was a period of time where the economy was going nicely, but the stock market went down and it's thinking that it was going to turn and go south. So what are we predicting in terms of the economy next year? So right now, earnings projections, the dark green reality is around, 12, 12 to 14%. That's not too bad at all. So let's do a quick hypothetical. So let's say the multiple stays exactly the same. And we have these earnings numbers hold true. Let's say earnings go up 14%. So if our multiple stayed the same and our rent went up, let's say 14%, our rate of return goes up 14%. But let's say we have a good economy and it grows by 10%. That's good. I'll take that all day long. But our multiple contracted 10%. We have a net rate of return of 0. So it's very plausible that the economy does well. We're doing okay with a 10% growth rate in the earnings of those companies. But because the multiple went from a very high level, even just down to a little bit of a high level, which is very plausible, very reasonable, we can have a kind of a 0% rate of return as those things kind of normalize a little bit. Again, that's just a kind of a hypothetical situation. But right now, the economy is doing well. Earnings projections are very nice. Profit margins are solid. So we don't really have much of a beat of problem with the economy side of the things. The big question is the multiple saying we're going to hit a home run. Maybe we only hit a triple. So when we're paying these lofty multiples, it doesn't take much of, let's say we only have okay numbers, that multiple could come down. So within a stock market, there's what's called value stocks and there's what's called growth stocks. So example of the growth stock world are a lot of your big kind of tech names are typically not designed to pay dividends. And where the overall multiple on the market, let's say, is 21, you typically are paying a premium because those are typically companies that are growing at a faster pace. So one of the things I want people to understand, something could be a great product, but a horrible investment. And so I don't want to give any examples of any individual stocks, but again, I'll use real estate as an example. Let's say we have a block and all the houses are around 500,000 and you have the best house on the block without a doubt. Pristine, everything's brand new inside, and you're charging rents that are 50% higher than everyone else. So everyone's house is around 500 grand and you have the cream of the crop. Okay, maybe I'll pay 5.25, maybe I'll pay 550 for that house. But if you were to ask 1.8 million for that house, I'm not buying. No one's saying it's not the best house on the block. No one not saying it's beautiful, the highest rent, all the above. But there's a point where we have to compare the price versus the rent, the earnings. So right now, we have a situation where growth stocks have done phenomenal. And comparatively speaking versus value stocks are what we would consider kind of cheap. So with multiples that are kind of below average, maybe some of the parts of the markets that are kind of unfavored right now, maybe a little bit of the banking sector, maybe a little bit of the real estate center, where you could buy these stocks cheap. They're not growing as fast, but we're able to buy them cheaper. So for example, let's say you like company A, you believe it should be trading at $50 a share, and it's only trading at $40 a share. So it's trading at a discount where you believe fair value is. So think of typically more dividend payers are a little bit more on the value side. On the growth side, you're growing at a faster pace, a little bit more of the technology world. So as we sit here today, value is fairly cheap compared to the growth side because growth have had a big run up. Now this breaks it down even further. So, a lot of people, and I understand, kind of love these large tech names, love US based, but we can always compare it to history. So what we're looking at on this side on the right is our multiples versus our 20-year average multiple. So for example, the last 10 years, like we say, large growth has been great, fantastic rates of returns, kind of mopping the floor with all different types of investments. So if you could compare it to a small value company, small growth company, anywhere on the kind of quadrant. So large growth is where you want it to be. But the question is, do we think that makes sense going forward? Well, Right now, for that large growth category, the 20-year average multiple we're paying to own those big tech names is around 19. Right now, they're trading at close to 29. That's like a 50% increase over normal. Does that mean they crash tomorrow? No. Does that mean they can't continue to go up for another couple years? Certainly could. But would that mean, hey, if we have some of those positions, would I take a little bit of profits off the table? All day long? That doesn't mean we abandon them. That doesn't mean they're not great growing companies, but we have to rebalance and be cautious when things are this expensive. More of a slide, just more of the behavioral finance psychology side of things. So what we're looking at here in the gray is calendar year rates of returns. Now, the red is the kind of the low point that happened in that given year. So for example, if we're looking at kind of, I guess we'll call it the 2004 timeframe, the year finished up 9%. But at some point in the year, it went down 8%. I see this all the time. Now, a 5%, an 8%, a 10% pullback statistically should happen a couple times a year. It's relatively nothing. But I also have the understanding of behavioral finance. Some of the people on this call are sitting with a couple $1,000,000. If you have $2 million and you have a 10% pullback, which might take a week, you might have a situation where a 10% pullback on $2 million, you just saw $200,000 evaporate in a week. And we have to understand that that's par for the course. This is just a normal part of the reality. This is statistically supposed to happen every couple of years. I'm going to say every couple times a year. I was listening to a podcast this morning. I thought it summarized it beautifully. One of the things that they were discussing on, are recessions really necessary? Um, with the government, can they step in and kind of solve all the problems and add to the money supply to smooth out all the recessions? Recessions are absolutely necessary. And the reason is, if we've never had recessions, then the stock market's always going to go up. If we know it's going to always go up, then people will take on tremendous amount of risk and debt to put in the market because it will always go up. So if you don't have a system that does have some checks and balances, periods of time where people are overpaying and underpaying, I don't think the system really works. So at the end of the day, it's human beings that are behind these numbers, are behind these companies. So we have to just understand that 5%, 10, 15, 20, it's part of it. And it's worth it in the long run. Stocks have had beautiful rates of returns over meaningful periods of time. There's really not too many things that provide that level of return. Put things in certain categories. It's my belief, rental real estate, the stock market, and owning your own business. These are the three categories, I would say, that statistically over time give you a good rate of return above inflation. Then there's a bunch of things in the middle, CDs, bonds, kind of personal residences. They normally keep up with inflation. Maybe you're in the 3-4% camp. Typically, cash is really the biggest loser over time. If we're in a recession, cash is king because we need liquidity, we need safety, we need to touch something that's not down. But if we're investing for 20, 30, 40, 50 years, there's not really money. I would rather you put your money anywhere else other than cash. With a government that prints the money as much as we do, that creates inflation. Inflation is just a fancy way of saying the value of the dollar is going to go down. There are periods of time where it's not happening. There's periods of time where it's happening at an excess pace. But again, long term, those are the kind of the different buckets. This is the way you want to think about them. You should have a little bit in all of those. That's the whole point of diversification. Now, what we're looking at right here is consumer confidence. So this is something that I just want everyone to take away personally. Like, I completely understand when you open up a statement and your stomach drops and you're like, oh my God, this is brutal. I'm down. It's really easy when I get to sit here and say, oh, you're down 6% or up 8%. Percentages, in one ear and out the other. But when you have the dollar amounts that you do, and most people on this call are sitting at all-time highs, when it's not 8%, 9%, it's 80 grand, 90 grand, or 200 grand that's moving around. I get that feeling. But every time when you get those really, really bad feelings, this is typically lined up with the absolute best time to invest. So if we look at this over time, you could pretty much line up recessions, what's consumer sentiment. And every time you look to the person to your left and they look to the person to the right and everyone's miserable, that's the time where you take some money out of your pocket and you buy stocks. You know, it's as really as simple as that. So every single, looking at periods in the gray here or the recessions, consumer confidence calling all-time lows, you're pretty much looking at a fantastic rate of return 1 year into the future every single time, which is kind of incredible. So again, you almost want to do the exact opposite of your instincts. As you see statements that are painful, creating you fear, anxiety, your confidence going down, normally the best time to invest. 2022 was the perfect example of that. Inflation was going through the roof. It was brutal seeing gas prices, food prices. You saw your stocks go down. Your bonds have gotten hurt like they never had before. Then markets go on a complete tear for 2 years. Fantastic time to invest. So just always something to keep in check. We're going to spend a few slides on the government, the presidency, what we kind of think may or may not happen over the next few years. Some that are just realities no matter what. Some are based on the current political environment. So we're thinking about the federal government and kind of what our spending it is and the deficit, I always want you to put things in certain categories. We don't invest in countries. We invest in companies. So people always think like, oh, the government's going to the crew and get the money out of the stock market. Well, what does that have to do with McDonald's selling cheeseburgers? Nothing. So very much put those apart. Now, certainly the governments can influence the stock market, influence the economy, kind of at a helping hand or a detractor a little bit. So it is a factor, but I always want you to put those two into separate camps. So without a doubt, we're in a little bit of a tough spot compared to our history. So as we sit here today, we have ballpark around $35 trillion in debt, and we're running rather large deficits. As you can see here, running almost $2 trillion worth of deficits. There's no quick fix to any of that. The reality is where a lot of people might point fingers and saying this is the problem or that's the problem. There's 4 or 5 things that we would call the untouchables: Medicare, Medicaid, Social Security, the interest on the debt, and military. It's really hard to cut any one of those 5. Those 5, as you can see here on the left side, are already more than we bring in. And they're going to go nowhere but up as the baby boomers continue to age into their kind of 70s and 80s. So we have a deficit problem. We have a debt problem. One of the ways we can do this is kind of grow our way out of it. Time will tell. And when saying that, when I say we have a debt problem and a deficit problem, it's like musical chairs. We don't know when the music's going to stop. There was someone like me doing a similar presentation in the 1980s saying, we have a debt problem. This is going to be horrendous. It's going to blow up without a doubt. And we're sitting here close to 45 years later, the music hasn't stopped. Now, it's very hard for the music to stop right now. And the reason is we're the big boy on the block and no one else, no other nation really comes close to us. So over the last few years, China was supposed to be this big competitor to the United States. With how COVID has gone out, their real estate reality is even worse than our 2008 real estate reality. Them taking over, becoming a bigger economy. If you look at projections 5 years ago and 10 years ago, they were supposed to overtake us, some projections by 2025, some by 2030. Now it's maybe 2050, 2075, and maybe never. So China becoming, don't get me wrong, they're still very big. They're still second biggest economy in the world. But in terms of really being a source of a reserve currency of the world, it's just not anytime soon. Europe has problems, Japan has problems. So more or less, us as a country get to continue to use our credit card. We don't know when this stops, but the odds of us not being the reserve currency in the world, if I was a betting man, it's not anytime soon. You have to grasp in the last 5 years, We all compare ourselves first 5 years ago or 10 years ago and what things cost in that reality. You don't compare versus Bob Smith in the UK right now, or someone in Africa or South America or in Asia. You have to realize us as a country compared to the other countries, we have lapped the field in terms of lower inflation, better growth. So comparatively speaking, there's a reason our stocks have done well and everything else has kind of done poorly. The reason our US dollar is close to all-time highs. Now, those things tend to regress back to a mean, but as a nation, compared to the other nations, we're in a good spot. So going back to the debt and the deficit, without a doubt, we have a problem. Without a doubt, we have to address a lot of the big ticket items that we spend our money on. But in terms of it causing some sort of cliff that we go over, it's just very hard for me to grasp why that would happen anytime soon without something replacing us. That's kind of the logic behind it. Now, one of the things and what we're seeing here is the red and the blue. So blue is kind of current projections. Here is the extension of the tax cuts. So when Trump did his tax cuts a few years back, the corporate side of it was permanent. The personal tax return side was not. They were supposed to sunset at the end of next year, so tax rates would go up. If I was a betting man and with a Republican House, a Republican Senate, a Republican president, there's probably going to be something that either they new tax laws or extend the current ones. Now, extending current taxes, you got to think of the country as a business. What does that mean? Revenue's not going to go back up. Revenue is going to stay lower. That means we have to run bigger deficits. We have to run more on our credit cards. So this is why you're seeing these red dots increase our debt at a faster pace. So what you're looking at this bottom right is our debt compared to the size of our economy. So this was World War II. Hence, we went into big debt, World War, spend whatever you got to spend to win the war mentality. And then we created this giant U where we continue to spend at a high pace. Like as I mentioned before, here we are in the 80s. A period of time where people thought, hey, the deficit's a problem. This is getting too big. Now we went into the 90s and we had a more or less revolution in the business world. You had the personal computer, you had your emails, kind of changed the game. Well, you're starting to see similarities between that time period and now. You're talking about artificial intelligence and ChatGPT and things of that nature that could unlock a different level to our economy. Time will tell. And that's where I'm talking. Maybe we can grow our way out of that. It's not easy. It's hard to find the sweet spot between growth and tax revenue. Time will tell if we can pull it off. So this is just another touching point with the economy. Like if I was going to give the economy right now a B, we'll take our economy right now all day long. The GDP is growing at a good pace. The jobs numbers, the unemployment numbers is pretty low. We still have a lot of jobs posting and available. So it does not look like any sort of recession is around the corner. But again, like I talked about before, a recession or an economic problem and the stock market are different. We could have the economy, which is companies' profits right now are all-time high, continue to be at all-time high, let's say maintain this level, but that multiple we were talking before could easily drop 10%. So you could pick your statements up a year from now and say, I lost 10%, maybe the economy's tanking. No, it could just have been the multiples getting back down to reasonable levels. So the big story over the last few years, of course, was inflation. So what we're looking at here is kind of the last 5 years of where it peaked and then kind of where we are today. So inflation peaked at roughly 9-10%, pretty horrendous period of time in that 22 timeframe. The goal of the Fed or the Federal Reserve was trying to get it down to about 2%. So this last 0.5% to 1% has been kind of sticky. I would say the belief in the bond market is that inflation is going to remain sticky. And the reason I believe that is more or less probably since the election, there's been a belief that, yep, Trump will probably either do a new tax law or maintain the existing ones. And therefore, our deficits are going to grow a little bit more, in which case bond investors expect or want a little bit more rate of return because they think inflation is going to be a little bit higher. So probably the best way to see this, it's what's called the 10-year treasury. It's kind of the benchmark for the bond market. So over the last 6 months, or let's take it a little bit further out, over the last year and a half, I believe it's the next slide. I apologize. So over the last 2 years, you had the 10-year treasury right around, let's say COVID, go as low as like 0.5%. And then with inflation shot up to 5%, went back down to about 3.5%, and now it's ticked back up to about 4.7%, which is a belief that probably some element of inflation is not going to go away. It's hard to kind of leave that or remove that last little bit. I'll give you a quick example. It's like, let's say you had a goal of losing 20 pounds. Probably the first 5-10 pounds is pretty easy, but the closer you get to that goal weight, you have to put so much more work to lose that last 5 pounds. That's kind of what we're experiencing right now. So as I think about the different markets around the world, and we have US stocks. So US stocks are trading at all-time highs, pretty high multiples. And there's also kind of some wines, there's a tailwind depending on where the dollar is. So for what we want, if we want US companies to do well, we almost kind of want the dollar to be cheap to help our exports be able to sell to other countries. And this is why things tend to regress back to a mean. This is why I think probably international emerging has a nice 5-10 year run, comparatively speaking to the US. Because right now our dollar is pretty close to all-time highs, which is great for consumers. So if you want to buy goods from overseas, it's a little bit cheaper. If you want to go on an international trip, great time to go to Europe, to go to Asia, to go to South America, because your dollar is going to go that much further. But again, it just makes it a little bit harder for our companies to sell. Harder there is to sell, less earnings, less growth, less multiple that we can justify. So again, it has kind of a compounding effect. So we have a Republican president, Republican House, Republican Senate. Now, it's been pretty clear that there's possible tariffs coming down the pipeline, trying to renegotiate with Mexico and Canada, renegotiate things with Canada and pretty much everywhere around the world. Now, this slide is rather shocking. So this lined bar graph right here, this is what's being proposed under the new tariffs. So this is going back to the 1930s. This is kind of where the history of tariffs we have on other countries, and then we're kind of ballooning up to what we were maybe 100 years ago. It's very hard to tell where we are as a nation, where the markets are, because Trump's a little bit of an unpredictable character. The story I keep telling everyone is we have a bell curve of statistics. So in the middle, the highest point of the bell curve, that's probably what's going to happen, kind of base case. And then you have what's called tail risk. Tail risk, things go really, really well, and tail risk, things go really, really poorly. My assessment of the current reality, both tail risks have gone up. I think there's certain situations where I think I could certainly see everything's humming at a beautiful pace and we're doing beautifully. And also, hey, when you start picking fights with people, sometimes you get a tit for tat type of war kind of escalation. So, it adds a little bit more kind of volatility to the mix. Do I think 100% of these tariffs are going to be put into place? No. Do I think this is some part negotiation? Yes, but kind of hard to tell. But I could tell you, if what we're looking at here is put into place, give an analogy, it's like let's say you haven't worked out in 10 years and all of a sudden you're going to wake up and work out with Navy SEALs. You can't shock your system that much. Something's going to break. You're going to get injured. So we'll see what comes down the pipeline. But something to keep our eye on, more or less. So this is touching on interest rates and the bond market. So what we're looking at here is the kind of the Fed funds rate. So the governments control kind of the short end of the curve, or kind of short-term bonds. So to give us a little bit of a history, here we are in the 2008 financial crisis. So the governments lowered interest rates to try and stimulate the economy. 2008, the world's fallen off a cliff, so they lowered rates to zero. The thought process is, hey, if it would cost you 6% to mortgage, if it only costs you 3%, maybe a bunch of more people will buy a house. More people buy the house, stimulates the economy. So a tool that the government uses cuts interest rates to try and stimulate the economy. The exact opposite was here in 2022, where inflation was so high, they wanted to cool it down, so they raised rates. I always give the example, let's say we're going to renovate your kitchen. Well, if this was 2019, you go to the bank and say, I'll take a line of credit and cost me 3% a year in interest. Well, now that line of credit's 8, 9%. Maybe you're not renovating that kitchen. Maybe you'll hold off until you get a few more bucks to kind of pay for it. So as we're looking right now, we have a reality where they started cutting interest rates a little bit. Now, this slide over the last year or two was much sharper down, and now it's starting to level off. So the blue here is what the government predicts is what's going to happen. The green is what Wall Street thinks is going to happen. So I do believe interest rates are going to stay higher, but partially because inflation's being a little bit sticky and the economy's holding up okay. So they don't need to cut at a drastic pace. For most of the people on the call here today, that is a good thing because you're kind of exiting the borrowing phase of your life. You're more in the saver part of your life. So what do savers want? We want bonds and CDs and money markets paying nice, healthy interest rates. We want 4, 5, 6% interest. That's great. That means our money is growing. The borrowers, this is painful. I got a mortgage at 6, 7%, not so fun. So if you're approaching retirement or in retirement, the new reality compared to the last 10 years is great. If you're trying to borrow money in your 20s and 30s, this is kind of tough to deal with because you don't have the assets to enjoy the interest you can earn, and you're trying to borrow, and now you have to borrow at higher rates. So I do believe bonds are kind of have probably a little bit of a leveling off somewhere around here. Doesn't mean 1, 2%. I don't think it'll be, money markets yielding 6%, but somewhere in the middle there, which I believe is healthy. When mortgage rates were 3%, that's too crazy. People were borrowing way more than you were supposed to, kind of getting way ahead of themselves. At the same time, mortgage rates are 8, 9, 10%. You're going to hurt the economy. It's too painful. Debt should sting, but not be over the top. As you want to renovate a kitchen, maybe 9, 10% is too high, 3% is low, but you should think about it. It should cause you to have a little bit of anxiety of, all right, 5, 6%. Yeah, I could work with that. So debt should sting a little bit. And also savers shouldn't get, a 5-year CD paying 1%. So the current reality we're in, I think is pretty close to a reasonable reality. Hopefully mortgage rates can tick down into the 5s. I think it's a very psychological number that will help the market a little bit. And if that means bond investors and CDs are paying 4%, not terrible. That typically means inflation's around 2.5%. We're making a percent and a half above inflation. All right, I'm okay as a saver. As a borrower, 5%, 5.5%, I can live with that. So I think that's a pretty good sweet spot if we can maintain this reality. So I just want to spend 1 minute on the bond market and just how bonds work. So let's give an example of a bond. Let's say we bought a bond for $1,000. Think of it just like a CD. It's a 5-year CD or 5-year bond where you're collecting your, let's say, 5% interest for the period of time. And at the end of the 5 years, you get your money back. Now, the difference with bonds are priced every day. So that bond you bought for $1,000 is moving up and down in the market. Now, bonds don't move nearly as much as the stock market, but they do move. So what we're looking at right here, let's look at the U.S. aggregate, kind of your bond index. Let's say we have a yield, how much interest we're collecting of 4.9%. Now, let's say, think of it like a 10-year security or 10-year CD. If mine's paying 4.9, and let's say interest rates drop 1%. Well, if I'm collecting 4.9 and everyone can go only buy one paying 3.9, mine's worth more money. So what you get is your 4.9, but your total return is closer to 11% because you collected your interest plus those bonds went up in value. So as interest rates go down, value of bonds go up. Now, everyone felt the pain a couple of years ago, especially conservative investors, when interest rates went more or less from 1 to 5, a humongous move, in which case the value of those bonds got hurt a lot. They lost 13% over the course of that period of time. Now, one thing we always have to remember, like I just started at the beginning, the last 5 years and the next 5 years don't look anything like it. So I get a lot of people, hey, bonds don't make any sense. I've never made any money in a long time. Yeah, but we're now in a world where they're paying double to triple what they have in the past. And we're probably looking at an environment where interest rates are going down, not up. So bonds, if I were to give them a price compared to the last 15 years, it's an A minus B plus. US stocks going forward, maybe CC minus, because again, they're sitting at all-time high. International as a opportunity to invest, B plus, A minus, just because they're 40% cheaper than us. Again, that does not mean over the next 3 months or 6 months, US doesn't continue to trend up. Bonds will probably give you a nice return. And it doesn't mean international is going to beat it. But if the longer period of time, the more accurate those projections tend to be. Now, I just kept this slide in here for a couple of points. It's just kind of amazing, looking at a 10-year bond and the bond curve here. So on the bottom here is 3 months, 1 year, 2 year, all the way up to a 30-year, just the environment we're in. Imagine buying a 30-year government bond or like a 30-year CD and it pays you 1% for the next 30 years. Those people really got hurt as interest rates priced up. If let's say you had a 1% 1 year bond, you're like, no big deal, I'll go get a new bond in a year. But if you're stuck in it for 30 years, those prices got hurt a lot. But we're now in a nice spot. Like I was saying before, this is great for all my clients at or near retirement. Bonds pay 4.5, 5.5. I'll take that all day long. We now can accomplish a good rate of return without anywhere near the risk that we had to take over the last 10 years. The other talking point on this one is just like, if you have money in the bank, besides like your everyday money, you should have a checking account with your everyday money. You pick your number, 5 grand, 10 grand, 15, 20. I wouldn't go crazy above 25, but everything over that, I don't care if it's a CD, money market, something earning at least 3.5%. We don't want to give up free money because you got to realize you're really losing if you're not earning at least 3%, because inflation is 3%. So if you're only earning one, that dollar you go to use next year is not going to buy anywhere near the amount of stuff. So we have to maintain with inflation. This is just a quick talking point on a bond. So as I mentioned before, bond prices move up and down. But if you look at the starting yield, like I said, your bond index is paying about a 5% yield. What this is telling you is that more or less, you're going to always be about within 5-10 years, about 10% rate of return from that 5%. So it could be a situation where I can't tell you exactly what bonds are going to return over the next 10 years, but if my starting yield is 5%, maybe at the end of the 10 years, I made 5.5%, or maybe I made 4.5%, but the deviation from my yield, it won't be much. Where stocks can have a little bit bigger of a deviation, bonds are not predictable over maybe 6 months or a year, but over 5-10 years, if you look at your starting yield, that gives you a pretty good idea of total return over a meaningful period of time. This slide is kind of going over comparing US stocks versus international, and this is comparing the multiple between the two. Down here is where international is cheap, up here is where US is cheap, and we just kind of broke through the bottom part of it. So again, this is only a 20-year slide, but you could probably use a 50-year slide. And this is one of the more extreme examples of how high our multiple is compared to theirs. Now, again, it's not without reason. Our economy is growing and doing better than theirs. But again, going back to my example of the houses on the street, we have the biggest, best house on the street. But that doesn't mean if all the houses are going for about 500 grand, I could ask 1.8 million. There becomes a point when the price you're paying for those stocks or the stock market get too high in comparison. It should trade at a premium, maybe not quite the premium that we're currently paying. This is always one of my favorite slides, is the understanding. No one on this call here is investing for the next 1 month, 3 months, 4 months, 6 months, 1 year, none of that. So we have to understand we're long-term investors. So when we're long-term investors, we can't expect perfection. I would love it if I could get everyone 7% rate of return, and in a good year I got you 8, in a bad year I got you 6. That'd be fantastic. But we have to have exposure to markets, exposure to things that have risk, but those risks typically have a return associated. Short-term, you could have pain. Long-term, statistically, very small percent of the time you actually feel pain. So what this slide is going over, any 1 year period of time, comparing, call it a balanced approach or a 60-40, 60% stocks, 40% bonds versus all bonds and all stocks. So any 1 year, worst year was 2 years ago for the bond market. They went down 13%. A balanced approach, your kind of worst year between 1950 and last year was down 20. In the stock market, this is our 2008 situation where the stocks were down 37%. But if we just move a little bit longer term, 5 years, 10 years, 20 years, we say if we're in a diversified approach, balanced approach, which everyone on this call is to some degree, some a little bit more aggressive, some a little bit conservative, but we've never gone a 5 year period in almost 75 years where we've lost money. So that's meant if I stay disciplined, stay diversified, have the understanding that yes, markets go down, but they tend to go back up. And this is the difference. Individual stocks, when you're investing in individual securities, they can go down and may never come back up. So investing in individual securities is a different beast than a fully diversified portfolio, which might have a few thousand positions in it. Then we can track what markets do. When you're in individual securities, it's different. You have every individual company is different. There's a boatload of companies every single year that go bankrupt and they never come back. So this is why when we're in long-term retirement thinking, we want to try to be as predictable as possible. So if we say diversified, never a 5 year period in almost 75 years where we lost money. We just have to stay disciplined. In a year like last year, so the economy's going okay, nothing's going wrong, but the story you'll hear through all of my one-on-one meetings is we certainly have to rebalance the portfolio. So last year was a little bit of a one-trick pony. US stocks good, everything else did okay, not terrible, but okay. So when certain positions start to get too much of a weight in the portfolio, typically they're also the thing that does the worst over the next downturn. So in the 90s, growth names, large cap did great. Over the next period of time, your 2000 and 2005, it was the worst. They lost almost 70%. Then from like 2000 to 2008, what did great? The banks and real estate, and everyone was pumping and buying houses and doing bigger and bigger things. Then what was the worst part of the next part? Banks and real estate. So typically what's happening is something's getting expensive. People have FOMO. If you're missing out, buying what's, a little bit greed's kicking in, that's typically the worst time to buy something. So we just want to stay disciplined, rebalanced. If we have a nice profit, beautiful. We're going to rebalance buying what's cheap. And what's nice when we rebalance, part of that's going to bonds where it was painful for the last 10 years. You're going to bonds and make 2-3%. Now we get 5.5%. That's not a bad place if we think stocks are a little bit on the expensive side. This is my last slide of the night. Last year was an election year. So depending on which team you're on, you either thought it was the greatest thing in the world or the worst thing in the world. You need to kind of break your psyche out. And this is just talking about your money and personal finance. There's a whole bunch of reasons to be upset or happy. Be my guest. But my role is money and personal finance. So we have to break the link between the two. So what this slide is showing you, it's showing you when the elections are, or the changeover with a presidency. And what you're seeing, the red is tracking Republican. And what he's saying is more or less he thinks under Bush, the economy's great. And then once Obama gets in and the Democrats get in, that same economy is now horrible. Oh, and Trump gets in, the economy's great. Oh, Biden gets in, the economy's horrible. And again, the Democrats are doing the same thing in reverse. Now, if you look at the bottom here, what happened under Biden? I heard people left and right, and again, the inflation story is absolutely real. But the S&P 500 averaged 13% a year. I'll take that. And the economy grew at 3% a year. Yeah, I'll take that. Under Trump, 16% a year. Economy, 2%. Without it, I'll take that. Obama, 2 and 16. You have to realize the economy is not lining up with a president. So, for example, under Bush, the 2008 financial crisis happened. So Obama came in, was right at the bottom of that reality. So he had a beautiful tailwind because markets were rebounded. Not that I'm saying Obama did anything great or anything bad. I'm not saying it, but it's just like sometimes the wind's at your sails and sometimes it's not. But for the most part, the economy is going to march right along. It's whoever the president is, McDonald's going to sell you that cheeseburger. They're going to find a way to make a profit. So yes, politics have a part. In my opinion, it takes an economy that's a B to a B plus, or maybe from a B to a B minus, but it's not this A to an F and F to an A reality. Um, I hope everyone got at least a few talking points out of that, some information that they didn't have before. Naturally, I'm always available if you want to have any further conversations on those or how that market update kind of ties into your own personal finances. But in saying that, if anyone has any questions, um, you can raise your hand. It's a little icon at the bottom of the screen, or if you want to just type it in the chat box, feel free as well. You're too kind. I get to go home and eat some dinner. Well, I hope everyone had a wonderful New Year's. If you ever have any questions, always feel free to shoot me an email or give us a call. But thank you so much for staying with us tonight, and looking forward to seeing everyone soon.